Hello and welcome to a brand new show of Deep Dive with me, that is Nikunj Dalmia. Now today the topic we would be discussing is that has US markets topped out? Now if US markets have topped out, I just want to put some thoughts here for viewers. US currently account for 70% of the total market cap of the world, 60% of the total debt of the world, and only 5% of the total population. So if US markets have picked out, dollar would weaken, flows will move out, yields are cracking. But will that money move to India, emerging markets like China, or could it find its way back to Europe, which in a sense is also showing signs of life which is coming back? So what we would be discussing, deliberating, ideating is that where will money move? Will it be India? Will it be Europe? Will it be other emerging markets? And how you can really understand from this trend, which is that if US has peaked out, what it means for foreign flows, especially into India. Now here's a graph which in a sense just tells you the complete story of where we stand. Why will money move to Europe? It's a rebound trade. Europe has been the sick man of the world. The economy has done nothing. They have very little in terms of innovation. The AI superbug has not really impacted Europe. But now looks like Europe is coming back together. They're talking about spending. The largest economy is Germany. The bond rates have gone higher. The German economy is talking about extra defense spending in order to protect the borders and boost up their indirect economy. China, cheap, tactical, outperformance. But is it a structural story? The answer to that is no, because there are far deep-rooted concerns in China which the markets have been hit by. India is structural, which is not today, tomorrow. Next 3, 5, 10 years, if you want to take a bet on a market which could give you a potential compounding of double digit, both on absolute terms and again in nominal terms, I guess India gives you that real structural bend. So I think this graphic in a sense is very important for us to understand that if US markets have picked out, where would flow move? Europe, which is a rebound trade up until now, because that's what data is indicating. China, which is tactical trade. Tactical is short-term viewers. Short-term means that in the near term, you may just want to say, okay, I'll buy this market. It's like they say in English, you will rent Chinese stocks, you will not marry Chinese stocks. India, well, structural. When I say structural, it's like a marriage. You always marry it. So will India be that big structural theme where money will come back? Well, let's take that conversation forward with a China expert, Niranjan Avasthi, Senior Vice President, Head Product Marketing at Digital with Edelweiss. Nice to have you back. Thank you for joining us. I guess the graphic before we just put out on air, Europe is rebound, China is tactical, India is structural. I guess that's a summary of where we stand.
Yes, thanks Nikunj for having me. Yes, absolutely. I think so. You summarized it quite well. And, with US markets kind of peaking out while we don't know still, because the growth story for especially tech stocks remains strong. But because of valuations, of course, when we look at we'll take a fundamental view, looks like valuations are high. And usually we have seen, when markets peak out in US, the currency starts depreciating. It's good for emerging markets. And in emerging market, there are two markets to look at. One is India, which is of course a very, very strong structural story, and China. Coming to China, as you rightly pointed out, Nikunj, it's a tactical play. And like how this tactical play has played out really well for investors who have been investing and keeping their stance, positive on China for the last, say, 6 months or so. Chinese market has given almost 45-50% kind of returns. This actually came back after a long-standing 2 years underperformance in Chinese market. It started with government showing some willingness to change the sentiments of consumers and investors, giving some stimulus to the economy, and also accepting that the economy needs some stimulus. Before that, they were probably denying that economy will undergo the change on its own. It'll take some time, but then that willingness to come and support the market, be it equity market or the economy, actually took that positive turn and increased the confidence of investors. Second, valuations were quite cheap. The 1 year forward P for Chinese market was below 11. Currently, it's around 13 or so. Also well supported with a lot of numbers. When we look at micro indicators in China, the consumer durable sales is up almost 38-39% in December. the travel and tourism numbers are up. People are traveling, people are spending money. But again, it's a very initial green shoot. The real pain is still in the real estate sector, which contributes almost 14-15% to the economy. That is still struggling. But the other side of the economy, consumer confidence is slowly building up. People are spending. GDP numbers were very good after a stretch of almost 6 quarters. GDP numbers are above 5% at 5.4% for the last quarter of 2024. Uh, Coupled with this, DeepSeek release, DeepSeek release showed some confidence in the ability of Chinese when it comes to technology, and Chinese economy, and a lot of players in China is actually uh, trying to
Right.
build self-sufficiency in the tech space,
Right. Fair point.
especially in the advent of AI and all. So
Right.
I think so. All in all, this has kind of helped Chinese market to rebound and
Right.
give some returns to investors.
So Niranjan, if one has to understand, based on your conversations, understanding what we've discussed is, let's assume US has peaked out. I'm assuming. You never say never, but let's work with an assumption. कुछ तो assume करना पड़ेगा. Let's assume US peaks out. If US has peaked out, then will money move to Europe, which is rebound? Will it move back to China, which is tactical, or will it come to India, which is structural? Where do you think that flow, if it moves, it will move back?
See, Nikunj, I think so. It also depends what kind of capital it is. Capital which is coming via hedge funds and all, which is kind of tactical calls, it will definitely, move to China. But when it comes to structural money, long only money, it will come to India back. Europe, as mentioned, in the long run, if it has to be structural, it cannot be Europe, because Europe again played out well because of a couple of reasons. One is it was at a deep discount to US market when we compare to valuations. Huge underperformance versus US for almost 2-3 years. So again, for me at least, Europe was again a mean reversion and catching up with the global developed markets. But structurally, the structural money will definitely chase growth, and it will come in India. Chinese will attract only tactical money till the time they get their, house in place, whether it is in terms of growth, in terms of their, policies, and most importantly, how they, bypass the trade war that's happening. While, in absolute numbers, it may not impact their economy or overall market, because if you see MSCI China, only maybe a couple of percentage point companies' revenues are driven by US exports, but it will have a sentimental impact. Till then, I think so China remains a tactical play, but India remains a structural play. So flows structurally will definitely come to India. Tactical will go to China, in short.
Okay. So by the end of the year, if one is looking at perhaps identifying some tactical trades, and I'm talking about the Indian viewer here, should they go towards Europe? Should they go towards China? Or don't try to be crazy, just stay in India?
The tactical is always very tactical to, predict. I think so. As far as China is concerned, we had, released a note. We did a call with our JP Morgan team in which our feeder funds invest. And when the stimulus came in, we did tell investors that, things are looking good, valuations are cheap, and it could be a good tactical play. But after 40-45% return, still saying that China could be a tactical play could be a bit risky, because from here on, if returns were to come, it needs to be backed by fundamental growth in earnings and GDP growth. So maybe next quarter or so would be very important. I would say, in fact, with almost 20-25% correction in segments of Indian market, Indian markets would be more attractive, because when we were talking about China, it was in September. Indian markets were, in hindsight, we can say peaked out. China was at the bottom, but today I think so things are reversed. China is up 35-40%. Indian market is down almost 20-25% in the broader segment. So I would say, if someone were to bet, why not bet on India? Because growth numbers are still looking good. Overall economy is doing well. I think so. If someone wants to take that risk, India would be the market, I would say.
All right. Appreciate your time. So glad you could join us. It's almost 2:10, and what do we have on the market? Let's take a stock of markets where we stand.